Imagine reporting just like a massive drop in your top line revenue,
Right.
double-digit crashes in your operating income, a steep fall in your earnings per share,
Oh,
and then walking into a boardroom to tell your investors that your underlying business is actually healthier than it has been in years.
yeah. I mean, you'd either be laughed straight out of the room.
Or you'd be the CEO of a company pulling off the ultimate corporate illusion,
So
right?
exactly.
Welcome to today's deep dive. We are taking you straight into the mechanics of a massive healthcare turnaround today.
It is a wild one.
Yeah, we've got a stack of sources here detailing the Q1 2026 earnings call and press release from the global dialysis giant Fresenius Medical Care, which most people in the industry just call FME.
Right. FME. And, to understand the scale of what we're looking at today, you really have to realize FME isn't just like a local network of a few clinics.
Right, now.
They are a chronic care behemoth. They're providing life-sustaining dialysis treatments for nearly 290,000 patients worldwide.
Right. Which is just a massive number of people relying on them to, literally stay alive.
Exactly. I mean, they manage over 3,500 clinics globally. They employ over 100,000 people. So when a company of this sheer size tries to pivot its strategy, it is literally like trying to change the engine on a commercial jet while it's cruising at 30,000 feet.
Oh, man. And that is exactly our mission for this deep dive. We want to understand the actual mechanics of a turnaround at that staggering scale.
Yeah, the FME Reignite strategy, as they call it.
Right, FME Reignite. We're going to look at how a company balancing the literal lives of hundreds of thousands of patients manages to shrink its physical footprint, drastically expand its profit margins, and roll out brand new medical technology all at the exact same time.
There's a lot of spinning plates.
It is. So consider this, a masterclass in reading between the lines of corporate financial statements. Because when you first look at those Q1 2026 top-line numbers,
The optics are definitely brutal.
oh, they look like a disaster. I'm looking at the reported numbers right here in the release. Reported revenue for the first quarter was down 6% to $4,612 million.
Right.
Reported operating income dropped 14% to $286 million. And reported basic earnings per share, the EPS, it fell 17% to 0.43.
Yeah, those are heavy drops.
Right. Like, if I'm a casual observer, I'm thinking the sky is completely falling. And, every CEO loves to hide behind adjusted numbers when the actuals look this bad.
Oh, of course.
It's often the corporate equivalent of saying, well, we would have won the game if you just don't count the goals the other team scored.
Right, right.
So, okay, let's unpack this. How is a quarter with a 6% revenue drop actually an up quarter?
Well, you really have to separate the macroeconomic noise from the actual, operational volume. It essentially comes down to two major adjustments, constant currency and special items.
Okay, currency swings.
Yeah, FME is based in Germany, so they report in euros, but they do a massive percentage of their business in the U.S. and, well, globally. So when exchange rates fluctuate heavily, the reported revenue gets distorted. If you strip out those currency swings and look strictly at organic revenue, meaning like the actual volume of dialysis services and medical products they sold.
Physical things they actually did.
Exactly. Their revenue didn't shrink at all. It actually grew by 4%.
Okay, so the core business expanded by 4%, but the exchange rate mathematically punished them on the balance sheet to the tune of a 6% decline?
Yeah, pretty much.
Okay, so that explains the revenue part. But what about the massive drops in operating income and earnings per share? Because, currency swings can't explain away a 14% drop in income.
No, they don't. That drop is almost entirely driven by what FME categorizes as special items.
Special items, the classic corporate catch-all.
Well, yeah, but in this case, it makes sense. When a company undertakes a massive restructuring, the upfront costs of that restructuring are carved out as special items. That way, investors can see the underlying performance of the daily operations.
Okay, so if we ignore the special item...
If you exclude those one-time costs, operating income actually grew 10% at constant currency to $467 million.
Wow.
Yeah.
Yeah.
Their operating margin expanded from 9.4% to 10.1%.
Yeah.
And that adjusted earnings per share, it didn't fall 17%. It jumped 16% at constant currency to 0.91.
That is a wild swing. Let's use like a commercial real estate analogy here for you listening. Imagine you own a massive, aging, high-rise apartment building.
Okay, I like this.
And you decide to reposition the asset to attract higher-paying tenants, right? During the renovation, half the floors are gutted, there is dust absolutely everywhere, and you are bleeding cash to pay contractors.
Right. Your expenses are through the roof.
Exactly. So if an appraiser walks in that month, the immediate operating income of the building looks terrible because half the units are offline,
Right.
but the underlying structural value is actually increasing.
Yes.
Once the dust settles, those newly renovated units will generate a much higher margin.
That is the exact mechanism at play here.
Mm-hmm.
The dust in this scenario is the upfront cost associated with their transformation program, which they call FME 25+.
Okay, FME 25 plus is
Yeah. And the CEO, Helen Giza, was very clear in the earnings call that this reported decline in operating income wasn't a surprise at all. It was exactly in line with their planned phasing.
Planned phasing, right, so they expected the pain.
Exactly. They knew the renovation of their business model was going to be messy and expensive in this specific quarter.
Okay, so the financial dust dragging down the reported numbers is coming from this FME 25 plus program. Let's get out of the boardroom for a second and look at what that program is actually doing on the ground. Because, I mean, what does a healthcare renovation look like in practice?
Well, a major component of FME 25+ is actually shrinking their physical footprint to grow their profitability.
Shrinking the footprint.
Yeah. In this quarter alone, FME executed a plan to optimize their U.S. clinic footprint by exiting 64 of up to 100 selected clinics.
Wait, hold on. 64 clinics?
Yeah, in one quarter.
I mean, efficiency is great for a spreadsheet, but let's talk about the reality on the ground here.
Okay.
You are closing 64 medical facilities. If I am a patient who now has to drive, I don't know, an extra 45 minutes across town 3 times a week while feeling completely exhausted from kidney failure, I do not care about FME's operating margin.
No, of course you don't.
Shrinking access sounds inherently bad for the over 200,000 U.S. patients who rely on them. How is shutting down medical facilities a win?
Well, what's fascinating here is that this is the real friction point of this entire transformation. The strategy relies on aggressive consolidation,
Right.
meaning FME isn't just like locking the doors and leaving those patients to figure it out on their own. They're systematically absorbing the majority of those patients into neighboring FME clinics.
Okay, but still, fewer clinics.
You have to think about the macroeconomic environment for healthcare right now.
Mm-hmm.
There are crippling nursing shortages everywhere and massive wage inflation.
Right, so finding staff is hard.
Exactly. Operating 2 clinics at, say, 60% capacity just a few miles apart means you're paying double the rent, double the administrative overhead.
You're spreading your staff out.
Yes, you are spreading your highly specialized clinical staff incredibly thin. By consolidating those patients, you create fewer but highly utilized, fully staffed centers. It is really the only way to combat those inflationary pressures without compromising the staffing levels required for safe care.
Okay. So keeping 2 half-empty clinics open is just a massive drain on scarce resources.
Right. And exiting 64 commercial leases while paying severance and, moving all that heavy equipment, that is where those special item costs come from.
The financial dust.
Correct. Closing those clinics drove a massive $166 million in special item costs this quarter.
Wow.
But here's the mechanism of the payoff. By running a leaner footprint, the FME 25+ program delivered $50 million in additional sustainable savings in Q1 alone.
$50 million in 1 quarter.
Yeah. And their ultimate target is $1.2 billion in total savings by the end of 2027.
Okay, so you take the short-term hit to close the physical location, but you keep the patient revenue flowing into a much more efficient building down the street. And the numbers in their care delivery segment actually prove this is working. The sources show care delivery posted strong operating income growth, up 12%, excluding special items, reaching $398 million.
It's a huge jump.
It is. Though I did notice the earnings report mentioned this was supported by U.S. TDAP reimbursement regulations.
Ah, yes.
TDAP. Yeah. What exactly is TDP and why is it boosting their income?
So TDAP stands for Transitional Add-on Payment Adjustment for New and Innovative Equipment and Supplies.
That is a mouthful.
It is. But it's essentially a Medicare program. The government realizes that next-generation medical technology is incredibly expensive, right? And clinics might hesitate to buy it.
Because of the upfront cost.
Right. So Medicare provides extra funding, like a temporary add-on payment, to incentivize clinics to adopt new equipment.
Oh, that's smart.
Yeah, it's a massive government-funded tailwind that helps foot the bill for their tech upgrades.
Okay, so that helps the margin.
It does.
Mm-hmm.
But crucially, even if you strip away the positive TDAPA effects, the underlying operating income for care delivery still improved by 6%.
Hmm.
So the operational efficiency is very real.
That makes perfect logical sense. I mean, if you are funneling more patients into fewer clinics, you absolutely need the clinics you keep open to run with incredible precision. You
Exactly.
can't just cram more people into a room without upgrading the tools to handle the throughput. Which brings us to the actual technology they are deploying.
Right, the tech side.
Let's look at their care enablement segment, which is the products and technology side of the business.
So the focal point of the care enablement segment right now is the rapid rollout of their new 5008X CAREsystem.
The 5008X.
Yes, this is their next generation dialysis machine, and they are moving very fast with the deployment. I mean, it is already in about 100 U.S. clinics, and they have performed over 100,000 treatments with it.
But why is this machine such a big deal? A dialysis machine filters blood, right? What makes the 5008X the centerpiece of their tech strategy?
It fundamentally changes the mechanism of how the blood is cleaned.
Really? How so?
Well, traditional hemodialysis relies primarily on diffusion to remove toxins,
Hmm.
just sort of passive soaking across a membrane.
Okay.
But the 5008X system facilitates high-volume hemodiafiltration.
Okay, hemodiafiltration.
Yeah. Without getting too bogged down in the clinical weeds,
Mm.
it uses a combination of diffusion and convection. This allows the machine to clear out larger middle molecule toxins that standard dialysis just leaves behind.
Oh, wow.
Yeah, it mimics the natural filtration of a human kidney much more closely, which leads to better patient outcomes and, frankly, better operational efficiency for the clinic.
Because better outcomes means fewer complications, right? Which ties perfectly into their financial goals.
Exactly.
But the tech side of the business wasn't completely immune to macroeconomic reality, was it? The care enablement segment brought in $12,299 million in revenue, but they face some severe headwinds in China. What is happening over there?
They are dealing with what is called volume-based procurement, or VBP, alongside stricter tender requirements.
VBP. Okay, what does that mean in practice?
Well, in China, the government centralizes the purchasing of medical equipment for public hospitals.
Right?
So instead of FME selling machines clinic by clinic, the government puts out a massive national tender. The mechanism of VDP forces companies to drastically cut their prices in exchange for winning massive guaranteed volumes of orders.
So the government basically uses its monopoly power to crush FME's pricing power.
Yes, exactly. It compresses their margins significantly in that region.
Ouch.
Yeah, but however, the strength of FME's global footprint is that the negative impacts of China's VBP were entirely offset by the strong sales of the 5008X system and positive pricing developments in other global markets.
Okay, so they balanced it out. Now, here's where this deep dive gets really interesting for me.
Okay.
We've talked about physical clinics and the machines inside them, but there is a third pillar to this transformation: value-based care.
Yes, the big shift.
This segment brought in $490 million in revenue, and its operating income more than doubled to $9 million. Plus, their member months grew 5% to over 460,000.
Those are impressive metrics.
They really are. And for anyone not deeply embedded in healthcare finance, value-based care is a radical shift in how risk is managed. I like to think of it like car insurance.
Car insurance.
Yeah, traditional fee-for-service healthcare is like standard car insurance. It only pays out after you crash your car into a tree. The provider gets paid to fix the damage.
That's a great way to put it. But value-based care flips the incentive structure completely.
Exactly. Under value-based care, it is as if your insurance company proactively pays for your premium oil changes, replaces your brake pads, and rotates your tires just to ensure you don't blow your engine or skid off the road in the first place.
Right. It fundamentally shifts the financial risk from the payer-like Medicare to the provider, which in this case is FME.
So FME takes on the risk.
Yes. In the old fee-for-service model, a provider gets paid every time a patient sits in the dialysis chair. High volume equals high revenue, regardless of long-term health.
Right, you want more people in chairs.
Exactly. But in value-based care, FME gets a set amount to manage that patient's total health. If the patient ends up in the emergency room with a complication, FME eats the cost.
Oh, wow.
But if FME keeps them healthy and out of the hospital, FME keeps the shared savings.
That is a brilliant incentive alignment. And the sources show they are heavily utilizing the CACC program in the U.S. to do this.
Yes, the Comprehensive Kidney Care Contracting Program.
Okay, what does that involve?
It is a specific Medicare model designed precisely for this kind of risk sharing. FME is using AI-driven interventions to monitor patient data.
Wait, AI? How so?
Well, they track things like subtle fluid weight gain, missed appointments, or trending lab results. The AI helps predict when an end-stage renal disease patient might be on the verge of needing hospitalization.
So they basically use the AI to spot the red flags, and they intervene medically before the ambulance is ever called.
That's the mechanism, yes. And the fact that their operating income in this segment doubled to $9 million is really the ultimate proof that the FME Reignite strategy is working. The improved savings rate demonstrates they are successfully predicting and managing the risk.
But let me play devil's advocate here for a second.
Sure.
Anytime a massive corporation talks about saving $1.2 billion, closing 64 clinics, and maximizing throughput with new technology, the immediate fear is that the actual quality of human care is going to plummet.
It's a valid concern.
Right. I mean, are they sacrificing patient health to hit these operating margins?
It is arguably the most critical question to ask when reviewing a turnaround of a healthcare provider.
So what's the verdict?
According to their own clinical metrics, the answer is no. Despite the massive corporate shuffling and clinic consolidation, their medical quality remains remarkably stable.
Really? No drop at all?
No. They reported a 93% dialysis effectiveness rate and an 80% quality index. And they have maintained their quality leadership in that CKCC program for multiple consecutive years. The clinical outcomes are holding steady, while the financial outcomes drastically improve.
Okay, so we have seen how they are fixing the physical operations, upgrading the throughput with the 5008X, and mastering patient risk through value-based care.
Right.
Now, we need to look at what they are doing with the cash generated by this leaner, highly efficient operation, because the capital discipline shown in this quarter is extreme.
Cash flow is the ultimate truth teller.
Exactly.
You can adjust operating income all day, but you cannot fake cash.
Yep.
And FME's cash flow numbers for Q1 2026 are truly staggering.
Let's hear them.
Their operating cash flows skyrocketed 39% to $227 million.
Huge.
And their free cash flow, which is the pure cash left over after they have maintained all their capital assets and equipment, improved by an incredible 94% to $40 million.
That is massive. And, you know, with interest rates where they are globally, holding debt is incredibly expensive right now.
Yeah.
Where does FME sit with their leverage?
They are actually in a very strong position. Their net leverage ratio is sitting at 2.6x.
Okay, and what's their target?
Their target corridor is between 2.5x and 3.0x.
Oh, so they are right at the bottom.
Yes. Staying at the low end of that range at 2.6x means they have significant breathing room regarding their debt covenants. They aren't choking on interest payments, which gives management immense flexibility.
Which perfectly explains why they executed such an aggressive share buyback.
Yes, exactly.
If you are holding FME stock or just analyzing their market strategy, the pace of this buyback is arguably the loudest signal in the entire earnings report.
It really is.
Because they originally planned to execute a $1.0 billion buyback over 2 years.
Right.
Instead, they accelerated it and completed the entire billion-euro program in less than 1 year. In the first quarter alone, they repurchased 23.3 million shares for $941 million.
It's aggressive.
Why the rush, though? Why not hold on to that cash?
Well, if we connect this to the bigger picture, it goes back to that 2.6x leverage ratio. They have the free cash flow, and their debt is well managed.
Right.
So management is looking at their own stock and saying, the market is undervaluing our turnaround. By retiring 8.5% of their total equity in less than a year, they are executing an aggressive consolidation of ownership.
They basically shrink the denominator.
Exactly. Even if net income stays perfectly flat, by reducing the total number of shares in existence, you mathematically force the earnings per share to rise.
Because there are fewer slices of the pie.
Yes. Every remaining share is now entitled to a larger portion of the company's profits. That is the structural reason why their adjusted EPS grew by 16% organically, even while they were absorbing the heavy costs of closing clinics and restructuring.
Man, it is just high-level financial engineering, perfectly synced with operational improvement.
It's an impressive playbook.
Which brings us to what FME expects for the rest of the year. They confirm their 2026 outlook. They're expecting broadly flat revenue for the year against a massive base of over $19.6 billion.
Right.
But because of the clinic consolidations, the efficiency of the 5008X machines, and the AI interventions in value-based care, they are targeting a highly profitable operating income margin between 10.5% and 12.0%.
They are purposely shrinking the top line to drastically expand the bottom line.
Yeah.
It is the textbook execution of shrinking to grow.
Yeah, shrinking to grow. And as we wrap up this deep dive into FME's Q1 results, I want to leave you, the listener, with a thought that really builds on the mechanics we've uncovered today.
Yeah.
We are watching a legacy healthcare giant purposely become leaner. They are closing physical locations in neighborhoods. They are relying increasingly on high-throughput technology and AI-driven predictive models to manage patient health from afar, stepping in only to prevent a catastrophic hospital visit.
It really is a fundamental rewiring of how chronic care is delivered to the patient.
It is, which makes you wonder, as these systems become more advanced, will the future of chronic care be less about the comfort and convenience of having a physical clinic on every corner and more about the invisible predictive power of the digital network monitoring your health?
That's the billion-dollar question.
Are we ultimately trading physical proximity for algorithmic precision? It is definitely something to ponder about the future of your own healthcare.